Before I begin, I just want to remind you that I am not a financial advisor, and please read the disclaimer on my channel page before viewing this video. I am not responsible for any losses you may experience in the market, and nothing I say should be taken as investment advice. So in this video, I want to show you how to select a financial advisor and also what tools you can use to hopefully find a financial advisor that can work well with you in your area to help you achieve your financial goals. So the first slide is just things to keep in mind before you get into finding a financial advisor. And the first one is that anyone can call themselves a financial advisor or a financial planner. Some states have licensing requirements to become a financial advisor. Some states have less licensing requirements, but the point here is that it's pretty easy to call yourself a financial advisor. So just be careful, and we're going to go through everything here in this presentation of making sure that the person you are entrusting with your wealth is actually credible and can actually provide you financial advice that can help you reach your financial goals. Second thing here is just do not go with advisors just because a friend or family member recommended them. Just because it works well for your friend or family member does not mean that that advisor will work well with you. Kind of goes into that third point there, is that not all advisors offer comprehensive services. Some might only specialize in investment advice or other services such as insurance or taxes. Some might specialize in other fields as well. Your family member or your friend might also not have done enough research on the advisor, and therefore they could have hired someone who's not well trained or able to provide the best advice out there. So how do you find financial advisors? Well, first resource is that you can use the web. And one website I like, and this is actually a new website I think they're in their beta stage still, but it works well, is findthebest.com, and they do have a financial advisor section, so there's the link right there. You can go on there, you can type in your location, and it will bring up all the advisors in your area. You can see how much money the advisor has of assets under management, and you can also check what the average account balance is at that advisor. Another resource you can use is the SEC. There's their website right there. And you can also use professional designations, the people who put out those professional designations. And the two designations I think are the best in this industry are the CFA and the CFP. And both of those websites can provide you with search engines to find someone in your area that has one of those designations, one of the respective designations. And like I said, you can go to your family and friends, but if you do, just put their name on the list and definitely put that advisor through the same interview process that you would put all your other advisors. So how are financial advisors paid? Well, there are three main ways that financial advisors are paid, and the first one is that fee-only advisor. And these guys are paid only for the advice that they give. They do not earn commissions by selling financial products such as life insurance or mutual funds, and therefore, because they're paid a flat fee, they are probably less likely to have a conflict of interest than advisors who are paid in the other two payment schemes. And the reason why is because they don't get paid a commission, or they don't get a bonus for selling you a certain mutual fund or putting your money in a certain mutual fund, insurance product, exchange traded fund, you name it, and certain investment product. They only act in your best interest because they get paid. If you do well, they make more. So usually they have a flat fee, so if your assets go up, their fee kind of goes up because they'll charge, and we'll get there I think the next slide, but they usually charge 1% of your assets under management. So if you do well and your asset base goes up, they make more money as well. So you guys kind of work on the same team. They're really making sure that your overall portfolio does well. Now the second type is a fee-based advisor, and they're very similar to a fee-only advisor because they are paid for the advice that they give, and they often charge a flat fee as well, but they're also paid a commission on some of the products they sell, some or sometimes maybe all of them. And unfortunately, this is the most popular fee structure out there for big firms right now. And I personally like the fee-only advisors because, like I said, they have less conflicts of interest than the fee-based ones. Because even though they say they can be on your side, and 99% of them probably will be out there to help you. I don't know, maybe it's less, but I like to think people have good intentions. But with the commissions, there is that little incentive there to maybe offer you this product, even though this other mutual fund, they might want to offer you one mutual fund because it has a little bit of a commission incentive on it, where this one over here doesn't have a commission, and even though it might be a better one, they might lean towards the other way just to get that commission, even though they know the other fund is the best for you. So they're not supposed to do that, but I'm not saying it doesn't happen. Hopefully one day we can limit that type of stuff. But when I look at advisors, I try and get the one that has the lowest conflict of interest, and that we share the same interests, and that we're on the same team. And finally, the commission-based advisors, they're paid from commissions on the products they sell. So these kind of like, selling insurance products or something like that. They're only paid when they actually sell you a product. And I don't like them because I just don't feel that they can be 100% conflict-free when they're only paid if they sell a product. So out of these three, my personal favorite is the fee-only advisor. Now, how much should you pay? Like I just said earlier in the previous slide, most advisors charge around 1% of assets under management per year for their services. So you should not have to pay more than that 1%, especially if you have a portfolio that is around $500,000. Now, if you have a portfolio that's less than that $500,000, they might charge you additional fees as well, because there are some fixed costs in running or having an account on their books, like back office custodian work, and the accounting for your fund and that type of stuff, and as well as paying the advisor. But if you have an account that's at least $500,000, you should not have to pay 1%. And if you have an account that's over $1 million, definitely negotiate a flat or reduced fee, a fee that's below that 1%, for all assets that are over that $1 million mark. So so up to that first $1 million, you'll probably pay around 1%. But for all assets that's above $1 million, definitely negotiate a lower fee. Most advisors will definitely be willing to do that with you. So the financial advisor designations. Now, everyone out there, or most advisors, have letters at the end of their names, and there's so many different combinations of letters that it almost looks like alphabet soup. So the top designations to look for are the CFA and the CFP, the Chartered Financial Analyst and the Certified Financial Planner. Those are probably the most two respected designations in the industry. The two below it are the Chartered Investment Counselor, that's the CIC, and you have to be a CFA in order to get that, so it kind of ties in there. And the PFS is the Personal Financial Specialist, and they are required to have the CPA designation, so they're an accountant, and they will definitely be able to help you with your taxes and everything. But those are definitely the top ones to get. Some other good designations to look for are the Chartered Financial Consultant, the CHFC. It's very similar to the CFP. In fact, it actually requires you to take the same amount of courses to prepare for the exam. And I think the CHFC actually has a few more extra classes you take. From what I know is the CFP exam, I think, is a little harder, and the qualifications or the prerequisites to get the CFP are a little bit more difficult than the CHFC. Another one is the Chartered Life Underwriter, that's the CLU, and that's very insurance focused. And those are kind of the big designations out there. Another designation is the CRPC, which is the Chartered Retirement Planning Counselor. I don't know too much about the difficulty of getting that one. I do know it's not as difficult as the CFA or CFP. And the CFA and the CFP are actually the most difficult designations to earn, and that's why I have them listed up top and in bold. So definitely try and get your advisor to have the CFA and the CFP. There are, like I said, an alphabet soup amount of other designations out there, but those are the two that are definitely the most respected in the industry. So when you do go to your advisor, it's very important that you ask your advisor some questions. And the first one is, what do you charge and what is your compensation structure? So get that fee-only, fee-based, or commission-based. Definitely, like we discussed before, which one's the fee-only is the one that definitely provides the less conflict of interest. So hopefully they can say we're fee-only. Second, you want to say, what are your credentials? So this is the designations, the degrees, and the professional achievements. We just went over the designations. I'm sure you can figure out the degrees and the professional achievement stuff. Number 3 is how much experience do you have, and make sure it's relevant experience. Now, if they say they've been in financial services 20 years, but maybe 18 of those years, they were out back, doing more of the paperwork type of stuff and more of a back office role and not really doing financial planning, well, then really they've only had 2 years of doing what they're doing. So that 20 years sounds impressive, that 2 years not so much. So definitely make sure that it's the experience they do provide you is relevant experience in the financial planning or investment management industry. So number 4 is, how often do you meet with your clients? Usually they meet with you 4 times a year, quarterly. If you have a smaller account, you might be met with biannually, so twice a year. If they meet with you more than 4 times, that's all the better. But try and make sure that they meet with you probably around 4 times a year is kind of the industry norm. And questions to ask an advisor is, I'm sorry, slide 2 on questions to ask an advisor. Number 5 is that are there products out there that I'm not going to be able to buy through you? For example, one is an ETF. Now, some advisors only have their Series 6 license, some have their Series 7. Now, if they only have their Series 6, they're only going to be able to offer you products. When I say products, I'm going to make a video on this later, but they mean mutual funds, exchange traded funds, insurance stuff. So those mutual funds, those are all considered products in this industry. Now, sometimes they can only sell you if they don't have the appropriate license. If they only have the Series 6, they can only sell you products that are provided through their firm that they work for. So you want an advisor, if you can get one, that can offer you any product out there, who doesn't mind investing in ETFs and all the mutual funds and stuff like that. They're not associated with any certain funds or certain financial products. So if you can do that, it gives you more of an investment horizon of where you can put your money in. And usually fee-only advisors can provide you with all the investment opportunities out there. Number 6 is how many accounts do you manage and what is your current average account balance? And I want to say this because if they say that they have a lot of clients and their average account balance is pretty high, then other people out there have entrusted them with their funds, which probably makes it more easy for you to trust them with your money. And hopefully people out there that did gather sizable amounts of wealth, were educated enough and were responsible enough and have continued to work well with the advisor, that they stayed with them, and that you can kind of trust their judgment when you're trying to make your decision on if you should go with that person or not. And finally, number 7 is what third-party custodian do you use to handle my capital? And you'll want to ask this one in case the advisor's kind of independent, they have their own storefront, they're not through any larger financial advising company. And the reason is because you want to try and avoid the Ponzi scheme type of stuff that's out there. And if the advisor is through, let's say, a Charles Schwab or a Fidelity, if that's who they do the custodian work with, or another well-known company that you know of, then they're probably very credible, and you know that your assets aren't going to be put into a fraudulent scheme or something, and that your capital will be in the right hands. So what the custodians are is those are the people that actually hold on to the funds. Those are the people that manage the accounting on the account. They're the people that cash the checks, mail the checks out when you redeem money from your account, type of stuff. So definitely make sure that it's a reputable custodian that is handling your money. Next is what your advisor should ask you. It's very important that your advisor asks you about you and everything about you. So be cautious of advisors that just ask you about your income and your assets. If they just ask about those two things, then they're probably only interested in how much you make and how much you're worth, because they're only thinking, how much can I actually make off of you? So a real advisor should definitely ask you about your goals, your risk tolerance, and your family situation, when you want to retire, how much you want to have in retirement, your lifestyle, that type of stuff. If they ask you everything, then they are definitely considering what works best for you and not considering what's going to work best for them. So some final thoughts is, if the advisor has the appropriate qualifications and answers your questions successfully, the questions I just gave you, then they are probably a good choice. Now, we can't guarantee that they're going to be a good choice, but you can limit your risk of hiring a bad advisor. So definitely do the work that you need. Do your good due diligence on the advisor so that you can try and select someone who will be a good steward of your financial future. And second here is, you are the interviewer. Don't forget that, and so do not be afraid to ask them the tough questions or say no to an advisor. If you interview with the advisor and you don't like what they had to say, or you don't think that you're going to work out, just because your initial consultation was an hour long, don't feel bad, oh, I took an hour of their time. That's what they do. They meet with clients and just say, thank you for your time today, but I feel like we're going to go with someone else. Interview several advisors. Don't just go with the first guy you meet with. So, and finally, never be afraid to fire a financial advisor if they are not meeting your expectations. So let's say you go with someone, but it turns out that they weren't quite what you thought they were, or they weren't as qualified as they originally said they were. If you can't trust the advisor, you can't be with them. So definitely don't be afraid. Just take your money back and go find someone else to manage your money. There's plenty of financial advisors out there. So thank you for watching my video. Please do subscribe to my channel, and I do wish you the best of luck in finding a financial advisor who can work well with you. Thank you.